Working capital refers to the difference between current assets and current liabilities. In layman terms, it's the measure of a company's short-term financial health and its operational efficiency. Hi, I'm Manu, and welcome to another episode of Sweet Money. I'm a CPA from Canada and the US, and I've got a cool little accounting firm better known as Shandel CPA. Now, you might be wondering what's current assets and what's a current liability. Your current asset would include items such as cash, inventory, accounts receivable, and other assets that will turn into cash within 1 year. And your current liabilities would be accounts payable, short-term debt, your credit cards, and other obligations that are due within the next 12 months. I'm going to give you some cheat sheets. The four main levers I want you to memorize is cash, inventory, accounts receivable, and accounts payable. Okay? As an entrepreneur, you should be highly fixated on your working capital. If your accountant or your bookkeeper is not talking to you about this specific KPI, you need to start questioning the quality of service you are currently receiving. Your working capital is the pulse of your organization that tells you how healthy you are. Once you fully understand working capital, you'll be able to evaluate four critical areas of your business. Number one, liquidity and short-term solvency. It ensures a company can pay its short-term obligations. Operational efficiency. High working capital indicates a smooth operation. A low or negative working capital indicates financial distress. Investment and growth. Sufficient working capital allows for you to invest in expansion, new projects, and acquisitions. Creditworthiness. Lenders and suppliers assess working capital to determine a company's ability to meet its obligations. Let's get into the different types of working capital. Positive working capital is when your current assets exceed your current liabilities. It indicates a strong financial health with the ability to expand in operations. Negative working capital, when current liabilities exceed your current assets. And this suggests cash flow problems and difficulty to meet short-term obligations. Zero working capital. This is when your current assets equal your current liabilities. And the company operates efficiently, but it's got to manage its cash flow very diligently. There is no room for error. Guys, since I'm dropping some sweet knowledge, I want you guys to give me some SLC. SLC stands for subscribe, like, and comment. And I'll be straight up. By giving me some SLC, you boost my ego. I can't lie. All right. Therefore, most importantly, when you guys smash that subscribe button or hit that like button or add a comment, the algorithm helps my content reach more people. And what that does is two things. Number one, it encourages me to produce more content. And B, this vital, important information reaches more people who can truly benefit from this. So please help make the world a financially savvy place. Now, let's quickly delve into the different types of current assets. We have cash. Cash is readily available cash. It could be in your checking account, savings account. It's at your disposal. Number two, your accounts receivable. Account receivable is money owed to you by your customers. Number three, inventory. Inventory are goods made available for sale. Number four, prepaid expenses. Prepaid expenses are payments made in advance. For example, if you purchase 1 year's worth of insurance up front, you now have a prepaid. You have an asset. Now, let's talk about the different short-term liabilities. Accounts payable. Accounts payable is money owed to your suppliers. This could be, for instance, you purchase raw material, you now have an accounts payable. Short-term debt. You borrowed some money from the bank, payments that you have to make within the next year. Accrued expenses. Accrued expenses can be when you receive a service, but you still haven't paid for it. And this could be, for instance, your phone bill. You've gone through the entire month, you used your phone, now the bill is going to show up. Now, working capital in itself, current assets minus current liabilities equals your current asset, really doesn't tell you anything. It really doesn't add much value. What you have to do is take this calculation a step further, and it's called the working capital cycle. Now, what that is we measure the time it takes for you to convert your net current assets into cash. Because let's be honest, cash is king, everything else is just a wannabe. In calculating your working capital cycle, we look at 4 levers: purchase inventory, selling products and services, collecting receivables, and paying off payables. So we take these 4 variables and we plug them into a formula. And the formula looks like this: days inventory outstanding plus your days sales outstanding minus your days payable outstanding. And this formula measures the time it takes to convert your inventory into a sale and that sale into cash. I'm going to state the obvious here. A shorter cycle means faster cash conversion and better liquidity. A longer cycle means capital has been tied up and it reduces your operational flexibility. And this, my friends, is the metric you have to measure every single month. You have to watch this metric like a hawk. This is the metric you have to focus on. If you start measuring this KPI month over month over month, it will tell you a lot about your organization. And this information allows you to put in place proper procedures and processes in order to improve the financial and operational efficiency within your organization. And quite frankly, having your finance person regurgitate numbers off a balance sheet doesn't do anything for you. Now, the $1 million question is, how do I improve my working capital? And there's 4 primary levers you have to focus on. These aren't the only 4, but they're the 4 biggest ones. Number 1 is speed up your receivables. If you're collecting money, if your DSO is 60 days, bring it down to 45. If it's 45, bring it down to 30 days. The lower you bring it, the better off you are. Number 2, optimize your inventory. If you're overstocking or if you have obsolete inventory, you're doing it all wrong. Try and implement JIT. JIT stands for just-in-time inventory. And if your accountant doesn't know how to, or your bookkeeper doesn't know how to implement JIT, give me a call, I'll help you out. Extend payable periods. Negotiate better terms with your suppliers. Stretch that 30 days to 45 and 60 days. Do the opposite of what you're doing with those receivables. Reduce unnecessary expenses. It's an obvious one, but it's pretty amazing how sometimes we overlook it. Now, that doesn't mean that you cut out essential services. What it does mean is you look for inefficiencies and duplication of expenses. Another metric that's very important and banks look at very carefully is your working capital ratio. And it's a very simple calculation. Let me quickly walk you through it. Let's say your current assets are $500,000. Your current liability is $300,000. Therefore, your working capital ratio is 500,000 divided by 300,000 is equal to 1.66. Now, 1.66 doesn't mean anything. What you have to find out, what is the right working capital ratio for your business and your industry. The only way to determine whether a working capital ratio is right for you is to have an intimate understanding of your business. And this requires data mining, and make sure you engage a qualified person to conduct this analysis for you. What a working capital ratio tells you is how many dollars do you have for a single dollar of current liability. So 1.66 means you have $1.66 of current assets for every dollar of current liability. In very generic and general terms, ideally you want your working capital ratio to be over 1.5. Okay? And the closer you get to 2, the more optimal it is. Now, back in the days when I was in the corporate world, I used to remove inventory from my working capital calculation. And the reason for that was inventory can be very fickle. It can become obsolete at any point in time. It can get contaminated. Trends can change, procurement issues, anything can happen. And your inventory can be rendered obsolete overnight. And in addition to the risk that inventory carries, inventory is your least liquid current asset that you carry on your balance sheet. Banks don't put a lot of value on your inventory. What you should be valuing is your cash and your accounts receivable. And even your accounts receivable can be heavily discounted because a financial professional, a finance professional, and a good banker will look at your aging and start to take away receivables that they deem are no longer collectible because they have become so old. The older your receivable becomes, the less relevant it becomes. So now what do? You're going to go back, rerun that working capital ratio calculation by taking out the inventory, taking out the receivable that you deem is no longer collectible, and then see where you stand. And if you're still north of 1.5, then my friend, you're doing it all right. And Manu is super proud of you. If you would like to assess your company's financial well-being, feel free to reach out. And remember, it all starts with a simple conversation.